Hi, and welcome back to another episode of the Enough Club podcast. I'm Bryan Nicol.
I'm Pieter Villiers.
And today we're going to jump into a topic that many of our clients ask us to unpack for them when they start working with us. And that is to explain you the workings of your employee benefits. It's those kind of investments and insurance that you get through your employer when you work with them. And what we have found is that our clients, as experienced, as qualified, as intelligent as they are, they often don't understand how these benefits work. They see it come off the payslip every month and they know that they've got something by some company that's being administered for them. These are extremely important benefits to have because it forms part of your overall financial plan. You'll be part of your retirement plan, part of your risk and estate planning. And so today we're going to go quite surface level, but we're going to jump into the various aspects of it just to try and add value by educating you on what you potentially do or don't have, what it means for you and your family. And then after this, you can maybe go out there, look at what you've got, and then assess if you're on track or not. So Pieter, I want to hand over to you first. Please break down for us the kind of categories of employee benefits that many employees have with their employers right now.
Yeah, it's always important for you to know what you have and what you are paying for, because every single thing here you are paying for. You might not know it, but if you go look on your payslip, you'll see that some of these your employer will contribute and you'll actually get taxed on that contribution. It's called a fringe benefit. So it's as if you would have earned the rand equivalent of that as a salary. And then some you are paying for and it gets deducted from your salary that you eventually earn. So that's always a great starting point. Just go look at your payslip to see what am I paying for. Now, there are two broad categories. There are the retirement fund benefits and there's the risk benefits. Retirement fund benefits would typically be a pension fund, a Provident fund, or a group retirement annuity. They are very similar in the sense that the rules around the retirement funds, they've kind of evolved over time where there were a difference between a Provident fund and a pension fund, but that's kind of been consolidated. And now with the two-pot system, you do get three different pots or three different components of each. We're not going to go too deep into that today. We'll probably make a whole entire episode on that. But basically, that is what am I contributing towards my retirement. And typically what you'll find with retirement funds is you would contribute a percentage of your pensionable salary. Now, that's an important term to understand because if you go look at your member benefit statement, it will say this is my pensionable salary and my employer and myself contributes 5% each of my pensionable salary to that retirement fund. And then you need to go and do the calculation, and that's typically what will get deducted from your salary. Now, if your employer contributes on your behalf, then that will be taxed as a fringe benefit in your name. So it's like you are earning that income, but it will also qualify as a deduction from your income when you file your tax returns as part of retirement fund contributions. So that's always nice. Now with risk benefits as well, usually your employer will contribute that on your behalf. And again, that's a taxable fringe benefit. The risk benefits will typically comprise of life cover. So if I pass away, it pays out to whoever I nominated, typically your spouse. Disability cover, that's split into two. There's income protection that will pay out if you are not able to do what you do, if you're not able to work. That gets split out into temporary income protection, typically up until 24 months, and permanent income protection if you are disabled for more than 24 months up until retirement date. And then there's also lump sum disability cover. That's now if you're permanently disabled, that will pay out, and you could use that to service debt or to make some lifestyle adjustments. There's critical illness cover. That is now if you are diagnosed with a critical illness, that might be something like a heart attack or stroke or cancer. And that will also now pay out a lump sum to make some lifestyle adjustments. And then often there's also funeral cover included for you, your family, maybe some extended family members. And then kind of under that broader category, you also get medical aid. So your employer might sometimes contribute towards a medical aid on your behalf, and you might contribute some sort of it. So they subsidize your contribution. And then also gap cover that will supplement your medical aid. So those are the main things that we will typically see as an employee of a corporate company, where your employer will contribute and help you have those structures in place, which is not something separate to your personal financial planning. This is very important to understand as part of your personal financial planning, to look holistically at everything, because oftentimes we find that these things have either not been looked at when insurances were taken out, or they might not even be accounted for when people calculate what they need to contribute to retirement. So those are the main broad categories. But Bryan, you can maybe take us a little bit deeper into maybe some of the important aspects of these different types of benefits that we often see clients find quite surprising.
And when we say clients find it surprising, once again, we deal with a lot of like heads of divisions or directors or senior managers, and they've kind of for 20, 30 years in their working career, they've looked at these documents and just thought, okay, I see these words, I don't know what they mean. And so what I want to do is just trying to empower you with some knowledge, some information about what these different things you see on your benefit statements actually mean, so that you can now make some decisions maybe in the future about these benefits and understand how it impacts your personal life. And so the first thing you might see next to a risk benefit. And so risk means insurance. That's kind of what it means, because it's covering risks. So insurance is like you mentioned, Pieter, is disability, life cover, critical illness. And you might see it say approved or unapproved. Now, it doesn't mean that it's legal or illegal or anything like that. Approved means the payment comes, it's within the retirement fund itself. This is a bit technical, but just think of it like this. You got the retirement fund where you're putting money in every month, and one day that will become your pension. Now imagine that retirement fund also kind of controls your life cover, for example. So the life policy is owned by that retirement fund on your life. And then if you die, it pays out into the retirement fund, and then that'll pay out to your dependents, beneficiaries, and that'll pay out to them. And so that'll be taxed according to the retirement fund tax table. Now, the retirement fund tax tables are sliding scale, and upon death or retirement, it gets taxed in a more favorable way than, for example, before retirement or death. And so your dependents will receive that money out of the retirement fund, and that is an approved benefit. And so approved means it's approved for a tax deduction on the contribution. So, for example, let's just say that life cover costs you R1,000 a month, for the sake of round numbers, and that gets taken off your salary and it goes there. That R1,000 a month premium is tax deductible. So you're paying less tax because you're contributing to that life policy that's within the retirement fund. But then when it pays out, it has to pay out according to the tax tables, or it can be turned for your dependents into an annuity to pay them like a pension income. So that's approved. Unapproved is different in that it is outside of the retirement fund. So it's kind of like a bolt-on solution, a risk solution to your retirement fund. Your contributions to that, your premiums that you're paying for the risk cover, is not tax deductible. It's a fringe benefit. So the contribution to your retirement fund, as we all know, is tax deductible. This is not. R1,000 a month, you get taxed on that. It's a fringe benefit. And then that goes through to the insurance company. However, the payout is paid out free of tax. So there's no tax on it. It doesn't go through a tax table like a retirement fund does, like approved benefit does, nothing like that. So it's cleaner. You get more money back. Yes, you don't get the tax deduction on the premium, but you get money back and you get it quicker. Your family or whoever the dependents or beneficiaries are, they will get it quicker because through the retirement fund, it takes a bit longer to wrap that up. So the approved versus unapproved, the way I remember it is my payment on the premium is approved for a tax deduction or it's not. And remember, if you get a tax deduction when you pay the premium, you're not going to get a tax, no tax on the payout. The government, or SARS, will always get their share. And so if you're not paying it in your premium, you're going to pay it on the payout. Or your family, will forfeit that amount. And then vice versa, if it's unapproved, you don't qualify for a tax deduction on the premium payment just for that risk benefit, but it pays out free of tax. Now, you can imagine if you have a larger benefit, say 5 times annual salary, and say your salary is 2 million, that's 10 million rand payout. If you pass away and your family decides to take all that money in cash, you can just imagine, you can work it out, the tax on that will be quite substantial. So now it might be more beneficial for you to have an unapproved benefit if it's within your control, because then it will pay out to the cent to your family, that 10 million, 5 times salary. So approved and unapproved, it's actually a big thing. it changes the way we plan for the families that we serve, because we know that money, how much will potentially come to the family, what can be done with it, and how long it might take to pay out. Another thing that you mentioned earlier on, and I just want to clarify, is you talked about a risk or a pensionable salary. So sometimes when you join a company, HR might sit with you and say, what do you want your pensionable salary to be? Is it 80%, 90%, 100%, 70%? And a lot of people will say, oh, what does everyone else choose? And they say, oh, 80%, and you go for 80. What that means is, if you look at your company benefits, your company doesn't know how much money you or your family need to pay out if you pass away. So what they do is they just use a one-size-fits-all approach. So let's just say you're employed by this big listed company and you're a senior manager. So you're on a specific category of benefits, exco or senior management category. And there you get, say, 5 times annual salary that pays out if you pass away or you're disabled, whatever the case may be. Now, how do they work out what the 5 times annual salary is? They take that pensionable salary or that risk salary. Now, remember, you set it when you join the company, and every year I think you can modify it once a year. So you said 80%. So you're not earning 2 million. Well, you're earning 2 million, but it's 80% of that. It's not going to be the full 2 million. And so 5 times 80% of your salary is what your benefit will be. So your pensionable salary has a direct relation to what you get out if you have to claim for anything. So you want to be careful about that. You want to make a good decision. If you have a financial planner or advisor, you make it with them, because it relates to your personal finances and what your family needs if you claim. Another thing I want to talk about quickly is a continuation or a conversion option. And this is golden. This is something we have to kind of execute or implement a lot with the clients that we serve, because what often happens is our clients, especially when they get to the point of they're starting to make work quite optional now. So they don't want to be fully employed anymore. They've got to a point where they can decide what they want to do with their lives, and they say, I want to consult. So now you want to consult, sit on a board here, consult to those companies over there. You're earning contracting fees or director's fees, but you're not an employee of a company anymore. So you leave this company that you worked for years, and they had all these benefits. But now you're like, say, maybe 50 or something. And Pieter, I mean, we all both know that the older you get, the less likely insurance companies are going to give you affordable insurance on your life or your health, or they might start excluding things. Like you've got a back problem and they just exclude any claims relating to your back. So there's this kind of like issue of getting cover when you're older. So when you leave this company that gave you all these benefits, you think, oh, geez, now I've got nothing. And I have to go to this insurance company and they're going to club me with premiums because I'm now penalized for my age. What you must do is look at your company's benefits and see if it has what it refers to as a continuation or conversion option. So the nice thing about that is that it means that you can take that benefit with you if you leave the company. Normally within a month, sometimes 2 months of leaving, you have to exercise that option. So you go to your financial planner, your financial advisor, and you say, look here, I'm employed by this company and I've got these benefits. I saw that they use the word, there's a continuation or conversion option. That planner will then contact that insurance company and say, look here, you're an employee there, you're leaving. Let's get quotes to see what that cover will be. So you get quotes. And the nice thing about that is that there won't be medical underwriting. They're not going to do medicals on you when you leave. They do 2 things normally: HIV AIDS test. And then if you say you're not a smoker, they do a cotinine test to see if there's nicotine in your blood. Because you can say, obviously, oh, I'm not a smoker, but you could be lying. Smokers are smashed with premiums, higher premiums. So that's what they test. They don't ask you about the other underlying issues that you might be dealing with, your comorbidities, anything like that. So now, if you are someone who is like a lot of us, get a bit of lifestyle issues later in life, maybe you've got a bit of hypertension or diabetes or something, and you're hopefully working on that, but now you still want cover, you can kind of leave your employer and you can take that with you, and they should be able to give you that cover without the medicals. They just test for those 2 things. And the last little bit of wisdom before I hand over to you, Pieter, is free cover limits. You might see on your benefit statement something like free cover limit or automatic acceptance limit or automatically accepted amount. And what that means is we're going to cover you for X amount of cover before we start asking you medical questions. So you work for the company, you're a senior manager, you're getting that 5 times annual salary payout for, let's just say, death or disability. And because they're insuring this whole risk pool of employees, maybe it's thousands, you all kind of cross-subsidize each other cost-wise and risk-wise. But now what happens is you're now getting to a point where your earnings have gone up. And we see this with our clients. You start going up the corporate ladder, your earnings start going a bit above the threshold for the insurer. They're like, jeepers, you were earning 2 million a year and we were happy to cover you for 5 times salary. You've now got a promotion, you're earning 2.5 million a year. It's a fundamental difference in the payout. That is now a bit rich for our blood. So what we want to do is we just want to assess your risk. We want to see if there's anything we should be aware of, because our limit was 2 million a year, or let's just say 2 million times 5 for death. So let's just say 10 million. We were happy to pay 10 million and not ask you any medical questions. But now it's gone up a portion. So now, I mean, what is 2.5 times 5? 2.55. We're filming this on a Monday, excuse me. So it's 12.5 million now. So there's now a 25% increase. So they say for that extra 2.5 million extra life cover that you're going to get now, we're going to ask you some medical questions. And so they send you a form. It's normally like a form, you fill it out. Then they say, okay, we'll cover you for that. It's no problem. And then they adjust the premium accordingly just for you. Or they say, look, yeah, you've got this issue, heart disease and this and that. We're not going to cover you for that amount, or we're going to exclude the heart condition. So we will, if you pass away and it's due to a heart condition, we won't pay out, but we won't pay out that extra little bit of 2.5. We will honor the full amount. So the free cover limit is what you will get regardless. Anything above that, they might ask some medical questions. So just keep that in mind. There's no free lunch in life. This is as close as you get to it. So those are some of the kind of the valuable tidbits that we picked up over the years that a lot of the clients that we serve don't necessarily know offhand. I hope that you do understand that now, that maybe it makes you think a bit. You can go back to your member benefit statements. You can go back to the documents you have from human resources, and you can be able to analyze that and kind of relate what we've taught you now with your own benefits. But now I've talked about the positives. Maybe, Pieter, you want to go into some things that the listeners should be mindful of about their benefits.
Yes, so as you read through the benefit statement, it's always good to kind of highlight and jot down the terms that might not make sense to you, because there's sometimes quite confusing and a bit overwhelming. But kind of like a few big things that we typically see that, again, this is your employer benefits, but it always comes back to your personal financial planning. So you might have an income protection through your employer. So that might be different names, sickness benefit, income protection, disability income, whatever they call it. And you have to go and check the waiting period. Waiting period basically means up until that period, once a period has been completed, the insurer will only start paying after that day. So for example, you get 7-day waiting periods, 14 days, 30 days, 3 months, 6 months, 1 year, and 2-year waiting period. So let's say now you are employed and you've got a 6-month waiting period. Now, if you are sick, you booked off for, let's say, 3 months, you've been in an accident and you're not able to work, you will have most likely sick leave that you can use. So maybe that's 30 days over a 3-year period. And maybe you've got some paid leave that you can also then use. But then once that is depleted, that's gone. The insurer will only start paying after 6 months and 1 day. So if that is the case, if you have an income protection through your employer, but it's a 6-month waiting period, that is a long time that you're not going to earn an income before that insurance will kick in. So in your personal financial planning, what you can do then is just bump up your emergency fund. Make sure that you can at least cover 6 months of expenses. I will probably want to bump that up to maybe 9 months or 12 months, just to be sure. If you have a 1-month waiting period, which is probably the most common one we see, then typically make sure that you have an emergency fund always for at least that 1 month, but you will then have the sick leave that you can use through your employer. So that's not necessarily an issue. But once we get to 3 months and 6 months, or maybe 2 years, sometimes there isn't even a temporary income protection available. It's just permanent income disability, which only starts paying out over 2 years. Then you need to think about emergency fund. or you might want to supplement that with personal income protection in your personal name for that temporary period, that first 2 years. Likewise, with the lump sum disability benefit, that won't pay out like income protection if you are only partially disabled. It's usually like you have to be permanently disabled, and it will then pay out the lump sum tax-free, or depending on whether it's approved or unapproved. But the definition for that is quite important, because now you get different versions of lump sum disability. You get your own occupation, you get own or similar, and then you get like any occupation. So just to try and explain that very simplified, let's say I'm going to use the example of a surgeon. A surgeon has a very specific type of role that he needs to fulfill. He needs to use his hands to cut, right? In a very simplistic way. Now, own occupation means if the surgeon cannot cut anymore, can't be a surgeon, that lump sum disability will pay out. But let's say now it's own or similar occupation, then if the surgeon loses his hand and he can't cut, you can still teach medicine. So then that lump sum disability won't pay out. And if it's any occupational disability and he loses his hand and he loses his voice, then he can still lift heavy things. So he can still be some sort of, pack things in a warehouse. So you have to go and look at the actual definition of that disability, and how likely that might pay out depends on your specific risk, what industry you are in, because it's pointless to have this cover in place and then something happens to you and you can't do what you have to do in your employment, and then doesn't pay out either. Then that becomes a massive risk that you are not benefiting from through your insurance. We also need to think about retirement funds. So typically there would be default contribution rates. So maybe it will say like for all employees, the employer contributes 5% and the employer 5%. So it's 10% in total. And unfortunately, like for most people, that's probably the only provision they'll ever make for retirement. This is just what the employer contributed. Now, you need to be aware that providing for retirement does mean that you actually have to contribute more than 10% most of the time, especially if you start later on. So you can sometimes add extra contributions to your pension fund. It's voluntary. It's called voluntary contributions, where you increase the amount that you contribute towards that to make sure that you are actually providing for your retirement adequately. So just don't always go for the default and accept that's going to be enough for retirement. There should be someone that helps you and do a proper retirement analysis to understand how much you need to invest. And you could decide to just focus on your pension and provident fund, or you can also start a retirement annuity in your personal side to complement what you have through your pension and retirement fund. So just make sure that you always understand the terms and when am I covered, when am I not, how long am I going to wait before this pays out. Sometimes critical illness cover also has percentages that it will pay out. So 25, 50, 75, 100%. So if you know you have a hereditary type of condition that you know, cancer or high blood pressure, hypertension, and that specific payout is quite low for the cover you have, then that's also something to just take into account of your personal financial plannings. They don't always show all of these detail in just the statement you ask for HR, and that's why you sometimes have to dig a bit deeper and go and ask the actual broker of the employee benefits to send you a specific explanation. The financial industry does not do a very good job at making these things easy to understand. So that is why it is important to sit down once a year, just go through all of this and see how does that complement, or sometimes even oppose what you have in your personal name, so that you are never overinsured, paying for things you don't need, or underinsured, not being adequately covered for your risks. Even though there might be a number, the definition for that number might not be suitable for what you need. And then you have to complement it on the personal side. And even if you've done all of this and you've revised it, don't keep it like that for 20 years, because life also evolves. You might, might now have children and your need for life and disability cover is high. A couple of years down the line, they're out of the house, you've paid off debt, you don't need as much life or disability cover as well. And that's sometimes, especially clients we see 5 to 10 years from retirement, they've got all of these benefits through their employers, and they took out policies in their personal names when they're younger. And now they are very much overinsured, and they've been paying premiums on policies for many years they didn't actually need. That's why it's so important to revise this every year, like you would do anything else, to make sure that you've got your actual understanding of the benefits that you have, and also how that complements your personal financial planning. Bryan, are there any other mistakes that you can add to that I've missed?
Yeah, thanks. So just quickly, you mentioned the overinsurance, and this is like a massive point, especially because of the life stage of the families that we serve. You often find that the kids are now older, like you mentioned, and the debt is being reduced. The need for a lot of the cover is gone. But also over time, the life, say you're like, say 50 years old, 55, you've maybe accrued a lot of policies you're not aware of. And these policies might be superfluous because they're overlapping with what you've got at the company right now. What I'm going to do is in the show notes, I'm going to leave a link to a post I made sometime last year online. It was a post on LinkedIn. I'll leave it so people can click through. It's a real case study, real calculations. We just changed the client's name and that, but it shows you that this client, the opportunity cost for them being overinsured for as long as they were until they appointed us was about 880,000 Rand. And when we looked at that with the client and we showed her the situation, she wasn't very happy. And she wasn't happy because she didn't take the time back in the day to go through her things and to see where there's overlap, where there is unnecessary covers. She just thought like, I've got these benefits, HR has got my back, and I'm covered and I don't need to worry about my personal benefits. It's extra. But the thing is that like, it's a big picture. Your company benefits, it's not your financial plan. It's just some benefits. And how does that impact the rest of your life? And so firstly, overinsurance is one of the problems we see. We see it a lot. So we kind of spend a lot of time. I mean, insurance companies aren't necessarily our biggest fans because we have to cancel quite a bit of cover for clients who are older now, and they don't need this cover. So we spend a lot of time freeing up money, premiums, by removing these policies. And we want to make sure that money rather works for you than paying for a policy you don't need. So overinsurance is a big one. And I think the other one is potentially just assuming that because you got benefits, you sorted. HR has set it up properly. The company, the exco, they've set it up properly for me. The company is not your financial planner. Human resources is not your financial planner. They will administer these products, but these are kind of these benefits that you have are designed for the average person. They're designed for the average employee. And I can assure you now, you're not the average employee. You have your own life. You're a unique person and you have unique demands and needs personally and for your family that need to be met. And so your whole picture needs to be looked at. So never assume that because you got benefits now, you're good. Like that's a terrible assumption to make. There first could be shortfalls. So you could need something else in another part of your life to cover what your company benefits don't cover. Or you could have things in your personal life that you took out before that are now surplus to demand, and you can get rid of them and free up a lot of money. And I think another thing is just not understanding what the benefits are and how they work. I have found before, I used to consult on a board of a employee benefits board, a trustee board for an employer. They were a national employer with employees all around the country. One of the trustees of the board, we were doing a kind of an annual education, and we were just reminding them of the benefits. And then after the meeting, the one trustee, who's an executive at the company, said, a couple of years ago, I had this thing in my heart, and it felt a bit dodgy. And I was taken to the hospital, my wife, and then I had a stent put in, a pacemaker, and all these things. So should I claim for that? Because now you're mentioning we've got this benefit, which they've had for like 10, 15 years. And long story short, he couldn't claim for it anymore. He could have got, I think it was 1 times or 2 times annual salary, tax-free, into his bank account because he claimed for, he could have claimed for a heart attack. And he didn't claim because he just didn't understand his benefits. And so there's, you're paying for something. And if you don't understand what you're paying for, you might not be able to enjoy the benefits because, you just won't know what you don't know. So those are kind of, in a nutshell, some of the issues that we see. And we don't want you to, if you're listening to this now, we don't want you to necessarily live in this position where you don't understand what you've got and why you've got it. And it's not difficult to get to understand it. So we're going to leave you with a practical little checklist. It's going to be, you will find out how to get it in the show notes below. And this is just basically going to help you understand what your company benefits are, the process to follow to get your hands on them, and to better get to understand what you're in line for. If there is a claim, what you can and can't claim for. We want you to be in a position of empowerment and to make some decisions and to get clarity. Because I'm pretty sure that if you've never seen all of your group or your employee benefits on one page, you probably don't understand them yet. And if you don't understand them, that's a problem. And so you got to solve that problem. Apart from that, nothing else from my side, Peter. Anything else you want to mention before we wrap it up?
I mean, if you think about everything you spent money on, if we have to ask you, like, draw up a quick budget, you'll probably be able to name most of the things your money is going towards. Your rent and taxes, food, subscriptions, insurances. Very few times people actually include, okay, but I'm actually also paying for this through my employer. I just don't know about it. I've never really looked at my payslip. I just look at that net pay amount, and that's the only thing I focus on. So just like anything else in your budget that you have to scrutinize, this forms part of that, because you are paying for it. It's maybe not in your personal name, but it gets deducted. And that is why it's so important that you understand, what am I getting for what am I paying? Because if you are paying for something you might not need, in this context, it's compulsory to belong to these Provident funds and to receive the risk benefits. But that might mean then something in your personal name, like insurances that you're paying, that you're overinsured, you might not need. And that could open up cash flow sometimes of a few $1,000s a month that could rather be invested. And that opportunity cost of not investing that amount is huge. And sometimes, I think I maybe just add back to income protection, most of the insurance companies will apply what they call the principle of aggregation, which means that, let's say I'm earning 100,000 Rand per month after taxes, and I've got an income protection through my employer that covers me for 100,000 Rand per month, but also I have a personal income protection policy through a insurance provider in my personal name, and I'm paying 3,000 Rand a month. If I get disabled and I can't work, now my pre-disability income was 100,000 Rand a month. Then these two insurers will talk to each other and say, well, we're not both going to pay 100,000 Rand and you're going to earn 200,000 Rand, because then you're going to be better off than before you became disabled. And the whole point of insurance is putting you back in the point you were before you became disabled. And then they might both just pay half of that amount. But you essentially paid for double the insurance. So you overpaid for something that you might not need. There are some insurances that work a little bit different where this does not apply, but across the board, most typically this would be the case. So again, make sure that you're not paying for something you don't need, because that might be money that you could either put into your bond to pay it off earlier, or you could invest it in the stock market. We just want you to be aware of all of this. And I mean, if something is not clear, there's always these AI tools that can help you to better understand all of these different terms. I won't necessarily throw my payslip and my member benefit statement to ChatGPT, not necessarily, but you might take elements out of that and say, hey, listen, I've got this, explain to me, what does this mean? That will get you very far. But your HR and the employer broker should also, it's their job to explain this to you, to set up a meeting and talk you through it, and just to make sure that you know what you have. And lastly, if you ever want to move to a new employer, compare apples with apples, because the new employer might offer a bigger salary package, no basic salary, and you might think that's more appealing, but then you lose all of these benefits that you might not get there. So you need to add all of these together to compare both options. And what Bryan mentioned, that continuation option is very important, especially as you get older. You don't necessarily want to be in a position where at the age of 50, you need to now take out new insurance because you missed the option to continue your cover. There's usually like a 60-day period. Whenever you leave employment, that's a very important period to actually look at what you currently have in place, what the new employer has in place, and then to make an informed decision in that transitional period. But I mean, there's so much we can further cover. If you guys want to know more about any specific areas of what we just chatted about today, please let us know in the comments. We'd be happy to make dedicated videos based on what your interests are and where we can potentially add more value.
Yeah, no, definitely. We could do an hour and a half, 2 hours on each of these benefits alone. Just one thing though, Peter, you're an exceptionally strict or boring financial planner, because you said if you free up money from canceling a premium, you can put it into your bond or invest. Why can't a person have a job? Kind of
They
boring.
can draw it if they want to. It's about the destination, but also about the journey. So yeah, sure.
About the journey, yeah.
Go spend that if you want to. I mean, it's your money. You decide what you want to do with it. As long as it's a sensible decision, go put it where it's most needed.
Yeah, just don't try and make a directors of financial services company rich if you don't need to. But that's all from me. So thanks very much. Thanks for your contributions. Thanks for listening. Thanks for your comments at the bottom. Please keep doing it, and please keep telling us what other topics you want us to speak about. Not just employee benefits, but anything else as well in the future. Anything to make your life easier and to add value. All the best until we meet again. Cheers.
Cheers.